Welcome to RBC's Markets in Motion podcast, recorded February 16th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review our stance on small caps. We had a little more love for them coming into Valentine's Day weekend due to better fundamentals, but still see challenges that raise the bar for further outperformance. Second, other things that jump out include more evidence of a tough reporting season, the slide in sentiment on the AAII survey, and thoughts on why we're not intrigued with the tech sector yet from a generalist perspective. If you'd like to hear more, here's another 5 minutes. Before we jump in, one programming note. The podcast will be off next week and resume later this month. Starting with takeaway number one, a little more love for small caps. Before the holiday weekend in the US, the Russell 2000 ended another choppy week on a positive note, but did take some hits, particularly after the jobs report dampened investor hopes for Fed cuts. We spent a decent chunk of our time with clients and internal partners last week discussing the state of small caps and thought it was a good time to review what we see for this corner of the equity market at the moment. There are a lot of good things we see going on within the space and for the space right now. In addition to maintaining its admittedly choppy outperformance trends relative to the S&P 500, we found that the Russell 2000 is outperforming private equity, as defined by an index of public equities that are involved in the private equity space. Additionally, we've started to see more of a high EPS quality tilt to performance within the Russell 2000, a welcome development for active managers. Earnings season has also been trending better for small caps than large caps in terms of EPS and revenue beats. These trends have slipped for the S&P 500 while improving for the Russell 2000. And this is also the case for the rate of EPS estimate revisions. This stat is slightly higher for the Russell 2000 than the S&P 500 right now. Additionally, bottom-up consensus net income growth forecasts are still pointing to stronger future growth in the Russell 2000 than the S&P 500, the Mag 7, or the Index X the Mag 7. Economic fundamentals are also starting to argue in favor of small caps, with improving U.S. GDP forecasts, a recent uptick in ISM manufacturing, and the latest NFP report, which pointed to weaker than previously understood conditions in 2025, but improvement in early 2026. Flows are also improving for small cap equity funds, both active and passive. And while small caps have often been treated as a buy the USA trade, we think US large caps and mega cap growth in particular have been in greater focus by non-US investors in recent years due to the AI theme, so are more likely to find themselves at the epicenter of geographical rotation. For all of these reasons, we came into Valentine's Day weekend with a little bit more love for small caps. We do think it's important to understand, however, that while the fundamental backdrop for this corner of the U.S. equity market has improved from a few different vantage points, there are still some challenges in place for small caps that could keep the relative trade choppy. Importantly, this area of the market no longer looks deeply out of favor from either a positioning or valuation perspective, suggesting that the bar for further outperformance has gotten higher and very dependent on the improved fundamentals staying intact. Per data from CFTC, total buy-side notional exposure has returned to slight net long territory and is right around levels that marked the peak in late 2020, early 2021, and early 2024, though there is considerable room to travel to get back to the more extreme highs that have often been achieved. Additionally, valuations are no longer sitting right in line with their November 2024 peaks the way they were a few weeks ago, but they have gotten close to those levels once again. We think that's why small caps were vulnerable to a bout of underperformance this past week when the Fed cut concerns resurfaced. It's been frustrating to us that this part of the market still seems to be getting jerked around by Fed views at a time when fundamentals are headed in a better direction. In the end, while deserving of more affection, small caps are simply not a trade for the faint of heart. Wrapping up with what else jumps out to us. First, more evidence of a tough reporting season for the S&P 500. Most sectors in the Mag 7 have seen a downshift in 2026 EPS growth rate expectations since the start of the year. This has also been the case for most industries. Along with EPS and revenue beats that are a little below the last reporting season for the S&P 500 and earnings sentiment, the rate of upward EPS estimate revisions that's tracking below the highs of last September for the S&P 500, its top market cap names, and the rest of the index, this data suggests to us that reporting season has contributed to the choppy tape. Second, sentiment slides but likely has more room to go. The AI jitters that have shaken the stock market over the past few weeks have taken a toll on investor sentiment. Net bulls on the AAII survey fell to 0.4% in the latest update, taking the 4-week average down to 8.8%. This was a significant move lower on this survey for the weekly data point, but it's important to note that sentiment does not look deeply bearish yet. If recent angst in the equity market persists and a garden variety tier 1 drawdown in the S&P 500 of 5 to 10% occurs, we'll be keeping an eye on this indicator for signs of extreme pessimism, as we think that what we're going through in the stock market at the moment is a type of sentiment unwind. Late last November, a brief move to one standard deviation below the long-term average helped confirm a bottom in the S&P 500 after its painful 5.1% drawdown, whose ingredients, as we discussed last week, bear some resemblance to what we're seeing in our indicators today. And finally, why we're not intrigued with tech yet from a generalist perspective. Given the damage to the tech sector in recent weeks, we're keeping a close eye on what our quant models are signaling for the sector as well as the industries within it. Note, these are models that we use to compare sectors and industries to one another, and we acknowledge specialists in the sector look at different things. At the broader sector level, our work indicates that S&P 500 tech has turned neutral, slightly attractive on our valuation model, which uses median forward PE, though the Russell 2000 version of the sector still looks expensive. Meanwhile, the rate of upward EPS estimate revisions remains high for the S&P 500 tech sector, though levels have drifted down to slightly below peak. Digging down deeper, it remains a tale of two sectors in some regards. Looking across the Russell 3000, software now looks attractively valued, but semis and semi-equipment still look expensive. Zooming out and taking a closer look at industry trends over time, it's worth noting that the rate of upward EPS estimate revisions remains high, but close to past peaks for semis, a sign of froth, but one that can likely endure for a while. While software EPS revisions have been moving lower, but haven't yet returned to typical troughs. Similarly, software PEs have fallen sharply, but are still above their GFC and 1991 recession lows. We also looked at software PEs relative to semis and found that the relative ratio hasn't reached historical lows quite yet either. In the end, we still see signs of froth on semis and a lack of evidence of capitulation on software. We've been market weight the tech sector and maintain that view today. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.